The Minnesota Housing Finance Agency offers up to $16,500 of down payment assistance through their program called the Deferred Payment Loan. It's called Deferred Payment Loan because there are no monthly payments and it's at 0% interest. So this is only offered through the Minnesota Housing Finance Agency, which is commonly called MHFA. We're going to go ahead and talk today about that program. We're going to talk about how it works, how to qualify for it, how to get it, and finally how to apply for it. So this is kind of your video that's going to show you everything that you need to know about the Deferred Payment Loan from MHFA. I'm Peter Lindquist with the Lindquist team. You know, if you like this video, it would mean a lot to me personally if you would click the little like button. And also, if you've got any questions or comments, please leave them in the description or leave them in the comments below. And then always feel free to subscribe to the channel. You know, we talk about a lot of first-time buyer issues and down payment assistance programs. If you're looking to buy your first home, there's really a good idea to subscribe to our channel. So how does the deferred payment loan work? Well, the first thing I have to understand, it's a second mortgage. It is not a grant. You know, a grant is where somebody is giving you money at closing in order to buy a property. That doesn't happen very often. This is a second mortgage. You are borrowing money. You can use it for both down payment as well as closing costs, and it doesn't add anything to your monthly payment, which can end up being a pretty big deal. This is not the same thing as a Deferred Payment Loan Plus program, although very, very similar. I'm going to put a link in the description below to a video that I've got specific to that program that goes up to $18,000. There's a few extra qualifiers on that program. And from you, all you need to do is end up qualifying. And from you, MHFA is asking for a minimum of $1,000 towards the transaction. Let me give you an example. Let's say we meet and I tell you you need $20,000 to buy the home. However, the deferred payment loan is $16,500. So we apply that against this. Now you have $3,500 remaining. I mentioned that you can get this down to $1,000, and you can do that by, let's say, seller paid closing costs. You could have the seller paid $2,500 towards your closing costs, or you could get a gift. You know, if you've got a family member that would be willing to do so. But one way or another, you can get it down to $1,000. If you're buying a 2-unit property with conventional financing through MHFA, there's a minimum of 3% of the purchase price that you need as your own funds towards that. So if it's a $300,000 duplex, you'll need $9,000. Now, it's important for you to understand that when you take out a deferred payment loan, this loan does have to get paid off. Mentioned it's not a grant, and it has to be paid off in 3 instances. One, if you sell the home, it's a second mortgage on the property, so it has to be paid. And also, if you refinance the loan, it has to be a Minnesota Housing Finance Agency first mortgage. So if it's anything other than that, then it has to be refinanced, which it can be. It can be put into a new first mortgage if you want to. And an important one is if you vacate the house. So you still own the house and you think, hey, I'm going to rent it out and go buy another one. You're going to get a letter from MHFA, and you need to pay that off. I've had some people say, well, can I pay on it early? Yeah, but it's 0% interest, so why would you want to? You know, unless you have absolutely no other debts. And even then, you'd want to pay on the first mortgage early, not on the deferred payment loan. So it's optimal that way. How do you qualify? Well, there's minimum credit scores for the MHFA startup program. There are maximum income limits, and then there's maximum asset limits. So if you have too much money, then this program is not available to you. You have to qualify for a first mortgage through MHFA. You can't get this loan independently. It has to be attached to an MHFA first mortgage. Now for credit scores, we use the lowest middle credit score of borrowers. So if there's 2 borrowers, 1 borrower, 5 borrowers, we're going to use the lowest middle credit score. And 640 is the minimum in order to get a conventional loan through MHFA. Now, just because you have 640 doesn't mean you're going to qualify for it. It still has to be able to run through software and come up approved, which is very difficult for conventional financing. For VA and USDA, also 640 for the credit score. FHA has 2 credit scores. One is 650. So if the lowest middle credit score is 650, you can get the deferred payment loan, but it is limited to for a debt to income ratio. It's limited to 45%. So your monthly payments have to be lower, and so oftentimes buyers will qualify for less than what they want if their credit score is between 650 and 660. Now, if your credit score is 660 or above, then they'll go up to 50% of your income, and so that's a much more liberal qualifying power. So our target, if you're qualifying FHA, realistically is 660. Now let's talk about maximum income. Now this ends up getting fairly complex. So MHFA will count the buyer and the spouse, whether the spouse is on the loan or not. If you're buying the house and you're living with other people, or living with somebody who is not your legal spouse, we don't need to count their income. But you're buying the house, and even if that other person's not on the loan, or the spouse is not on the loan, we have to count their income in the maximum income limits. That's true of the startup program as well. So startup has higher income limits, and then the deferred payment loan has lower income limits. For a household of 2 or less, for example, it's 89.2 in the Twin Cities area. Now, these limits vary in 3 different regions of Minnesota. There's the Twin Cities area, there's Dodge and Olmsted County, and then there's all other counties. I'm going to put all of these income limits in the description below, so please be sure to check that out. The household size is identified by number of people living in the house. So, once we get up to 8 or more, that income limit gets up to $142,800 for the borrowers on the loan and/or spouse, if they are, whether or not they're on the loan or not. I mentioned maximum asset levels. If you have too much money left over, MHFA says you don't qualify for this program. That's because this program is needs-based. So if you have $12,000 or more left over after using your money for the remainder of down payment that's not covered by this program, now you don't qualify. It's $12,000 or it's 8 times the monthly payment. So if your monthly payment is $2,000, then it's $16,000 that you can have left over. Now, consider just another thing for you a way to understand. Let's say that you have $16,000 and you fit in this example, but you're using $1,000 to buy the house. Now, the $1,000 is going to buy the house, and you have $15,000 left over. So you would qualify in that case if your monthly payment was $2,000. 8 times that $2,000 is $16,000. So it is $12,000 or 8 times your monthly payment, whichever is higher, and it almost always is that monthly payment or that multiple of your monthly payment. And for those assets, they're counting liquid assets. They're not counting retirement, 401k, pensions, those kinds of things. It's really just what is liquid checking, savings, stocks, bonds, mutual funds, CDs, that sort of thing. Now let's talk about how to get it. Well, first of all, you have to talk to a lender that actually offers it. That may seem obvious, but your bank or credit union may not even offer the program. So lenders like me and others have this program available to you, but you would have to come to us in order for you to get access to it. Minnesota Housing doesn't do these loans. They buy these loans. So they ask mortgage lenders to originate the loan, and then they are simply the investor in the loan and they buy it, okay? The same lender who gets you the first mortgage has to be the one that gets you the deferred payment loan. So you can't be going to, one lender and then call me for the deferred payment loan only. You would have to get both of those loans through the same person, which I hope would be me. It has to be an MHFA first mortgage. So you can't couple this with, a traditional Fannie Mae loan. It has to be an MHFA first mortgage. And then finally, I'll just note that anybody getting this type of down payment assistance, MHFA requires that for the benefit of this program, you need to take a class. And I'll put links in the description below about the online as well as in-person classes that are available. And finally, how to apply for it. Well, it's through your lender. So I'm going to put two links in the description below. One is to my app. That is probably the easiest way to apply online, or I'll put a link to my website and you can access it there as well. And one thing I'll note is that we do what's called a soft credit inquiry. So when you do a pre-approval through us by applying through my website or my app, it's not going to do a hard credit inquiry, so it's not going to hurt your credit. No matter what your credit score is today, it'll be that same thing. It's not, it has no impact. It doesn't even show up as a credit inquiry. It gives us the score that we need to know for you to qualify. Eventually, once you buy a house, we have to pull a hard credit inquiry. But for pre-approval purposes, this works really great. Hey, I'm Peter Lindquist with the Lindquist team. If you like this video, please be sure to give it the thumbs up. And if you're interested in buying your first home or you're a realtor, please consider subscribing to the channel as well. It would mean a lot to me, and I think you're going to get some valuable stuff out of it. Thanks, and have a great day. See you.
He's in.